Good morning, everyone. Welcome to the Market Mindset. Today we're joined by Fred Jones, who, amongst other things, has a strong background in commodities, bond portfolio and trading, and currently is the business development of Pan Pacific. It's a real treat because of the expertise, not only in Canada, but in the US markets, working at San Francisco and other notable cities. We get a real chance to understand what's happening in the market as far as interest rates, inflation, bonds, you name it, whatnot. This is a real treat and it's a real education for us. Fred, how are you doing today?
Not too bad, Andrew. How are you?
It's okay. It's a chaotic time. It's a very strange time. People of our age group, we know where interest rates can go. We know what the long-term average is. We've seen the 80s. But for a lot of newer people, newer investors, and also people that haven't been paying attention, this is a real wake-up call. We'd heard at the beginning that maybe this was transitory inflation. And we've heard a lot of different ideas from the government, from the mainstream news. Without going into too much too quick, what are your overall macro kind of thoughts? And then we'll kind of weed down into more specifics.
Right, for sure. Well, my base case is stagflation. That's where I start. People ask me that question. I just say my base case is stagflation, which is not a word that people we haven't heard it. We haven't discussed it in years, decades even, at least in the West. And so I expect inflation to continue higher structurally over the long term. I expect bond yields and rates to move higher as well. I think we're in the interest rate and yield cycle has turned. And I expect overall economies in the West, the data there, to continue to deteriorate.
When we talked before as well, and I'll bring this up as a highlight, is both Jamie Dimon over at JP Morgan, him making a statement, maybe we need to get used to 7%, 8%. And then, of course, Larry Fink over at BlackRock saying, well, 5%, maybe. But either one, 5 to 7 to 8. We're nearly at 5 already. What if someone goes, well, I thought this was temporary. What do you mean this is going to be long-term? What does that look like? I mean, the U.S., the mortgage rates is slightly different, but in Canada and countries like that have variable rate mortgages, but also corporations raising money, what does that look like? Like, what do people have to get their head wrapped around?
Right. So, for context, in 2022, we had concluded about a 39-year down cycle in yields because of inflation, because of central bank action, because of changes in the bond market and in the wider economic environment. That came to a juddering halt. 40 years of experience of things kind of going one way tends to fix habits in people's minds. I'm subject to it. I think we all are. I don't think the idea that the rate cycle has turned has been accepted by most people. And so I don't think the actions that people are taking are in alignment with that. And so as such, whether it's 5, whether it's 7, we can get into that. But it will probably need to go higher from here before people start to act in alignment with the idea that the yield cycle has turned.
I think, too, that takes into account like the length of time, because some people may just think, well, it's going to turn next year. Like, well, that would be nice, but there's no indication that this is going to rapidly turn back to a quantitative easing, or that even this, I hate using the term, the new norm. If they're suggesting, which say JP Morgan and Larry Fink as well, that this is going into 2025 and beyond, that's kind of giving a hint to people that this is a longer period of time than I think a lot of people are paying attention to.
Right, right. So, I mean, speaking of JP Morgan and BlackRock, so where would they get these ideas? I mean, what are they seeing? So JP Morgan, which absorbed my old bank, Bear Stearns, which had a very good bond business, they speak to global central banks, pension funds, sovereign wealth funds, mutual funds, hedge funds, large family offices. They are all over the map, all over the spectrum of fixed interest securities, sovereign debt, corporate debt, bank loans, mortgage-backed securities, convertible debt, you name it. Same for BlackRock. there's not a lot that they're missing, I think, in terms of just raw intelligence where it comes to observations and the data that's coming out of global fixed interest markets. So when they say 5 or 7%, I think what they're attempting to do is to create that context for people to think about what portfolios can look like in that environment, right? So what I would say is that maybe as opposed to getting fixated on a number, as you suggested, what does the time frame look like? Because time is as important as price, right? Sometimes it can be a bit more important. So whether the 5 or the 7, I believe, will occur over what time period, that's something we could discuss.
And it's interesting because, and you bring up an important point, their portfolio, that's what they specialize in. They have entire risk management divisions, and they'll stress test different models. They've said, like Jamie Dimon said, we can handle 8%, we can handle 9%, but that's not really the conversation for them. That's their expertise. The average person, though, or even a relatively sophisticated retail investor, they don't have a risk management division stress testing their portfolio. And even if they have some experience, they may not remember back when rates went higher and like, oh, what do I do now? And have I set up my 60-40 portfolio? How is that looking? Does that work anymore? There's a lot of questions, and we'll break them up into 2 different sections. One being kind of that more that corporate investment banking side, your sovereign wealth funds, to just your average person on the street going, well, what does it mean to me? Right. Like, what does this look like for me? Right. And maybe start with that risk management in mind. What would you as a bond trader be doing right now? Because I'm sure, it's funny to think that bonds are hot now. Like if you're a bond trader, this is like, okay, our time has come.
Right, yeah. Okay, so that's a little complex, but the average person and say a pension fund or an insurance portfolio, in a sense, they kind of have the same problem, all right? It's how would they address it? If I were running a bond desk, right? The 2 things that I would be doing, I would be reducing inventory, right? Which I think a lot of Wall Street firms have already done. They used to carry massive inventories of bonds, which partly for regulatory reasons and partly because of interest rate volatility, they no longer do. So they're no longer making markets, they're quoting them. Okay, so there's that. Secondly, in portfolio management, so we'll get esoteric for just a second, there's a concept called duration, which really has to do with interest rate risk. So if you're extending duration, you're taking more rate risk. If you're shortening duration, you're taking less. I would be trying to short duration inside of 1 year. This is typically where central banks play. Pension funds do the opposite, right? Why do they extend? Because they have payments that they need to make out to people. So assuming that they're getting a life expectancy correct, then they need to structure their investment portfolios to be A, stable, and B, to be able to fund payouts. In the last few years, they extended considerably. So the principal value of these portfolios in certain cases has been beat up 20%, 30%. The TLT, which is it's an ETF, kind of approximating 20-year U.S. government bonds. That's got cut in half over the last 3 years. So when you think about a government bond portfolio, particularly U.S. Treasuries, having the principal value getting cut in half over any period of time, it's just not part of anyone's thinking. Yet that's precisely what has happened. So we don't have a lot of public data on what's happened with pension funds. Yeah. If you go over to the retail investor side, okay, their problem is, so I went into the duration extension. Okay, so man on the street, they've done sort of the man on the street equivalent. What have they done? They've gone out, they've purchased very expensive real estate because the banks would commit the money at very, very low rates. So you're able to buy more house because you're able to borrow more money, not because you were making more. Yeah. Trouble being, in Canada, more and more of those mortgages were the variable variety, and so it didn't, because people were willing to believe something, These pension fund managers believe the same thing, that rates would stay low indefinitely. So getting that wrong on the pension fund side, it really massacred the portfolios. Getting it wrong on the retail side has caused mortgage payments to go up by 30, 40, 70%, 80%. Amortizations have been extended in an effort to keep people in their homes, right? But that can only go on for so long. So the retail borrower has a balance sheet problem on the liability side, and the pension fund manager has a problem on the asset side. Both are products of the same conclusions, the same assumptions, and the same thinking. So on the liability side for pensions, it's a little odd because that depends on life expectancy and how to make the payouts. We just know that the money really isn't there, and now if they were there to liquidate the bond portfolios, they wouldn't have the principal to reinvest at higher rates. So the pension problem, which has actually been brewing for years now, I actually wrote something about it in 2009. I think we can expect to hear more about that. But on the asset side, for the retail investor, sort of the 60-40, that no longer works for the same reason. So the 60-40 portfolio, right? I mean, that's the idea there, firstly, is that stocks and bonds are not positively correlated. Okay, that's not true. Yeah. Secondly, the 60-40 portfolio works best when rates are either falling or they're quite stable. But when they're falling, the correlations between stocks and bonds are both positive, and they're highly correlated. Why? Because bonds mathematically are going to rise in value when rates fall. Okay, stocks tend to rise when rates fall. Okay, so we're no longer in that environment. My case is that we've entered a new long cycle in rising yields. So then bond portfolios and stock portfolios must lose value. So if your business or your investment thesis is based on 60-40 and trying to move those allocations within about 5 percentage points on either side, that no longer works because the environment in which 60-40 might apply no longer exists. So yeah, the retail investor, the retail guy has a balance sheet problem on both the asset and the liability side. The institution of the pension fund manager, the insurance company, anyone that has depended on extending bond portfolio duration, they have a big asset side problem. Sorry for the long-winded answer.
No, but this is important, and because I wanted to kind of give a snapshot for everyone to understand that, I mean, in a good way, we're all in this together. It's not a good thing necessarily, but we're all in this together. And I'm going to throw another wrench into this before we get into some possible solutions and look at kind of this, the commodity cycle and whatnot, and some ideas that people can play with. Is we also seem to be having a situation in which China is dumping U.S. dollar as much as they can. They used to be one of the biggest holders of U.S. debt, and they seem to be kind of, my impression, and this might be a bit, hyperbole, dumping it as hot as they can, picking up gold, taking something else, saying, listen, or even oil, like we'll get involved with Saudi Arabia, but we're going to get rid of the U.S. dollar. As a monkey wrench, what does that, if you even think that's happening to some degree, you can tell me, or a lot degree, does that throw in a huge monkey wrench into the whole situation as well?
Yes. So exactly where does that monkey wrench land? So on the gold side, it's a bit tougher to see because the data on gold holdings coming out of China is really difficult to assess. They hold their gold holdings through a number of different vehicles. Plus, they use the Chinese population to hold a lot of that gold. On the bond side, right, on the U.S. Treasury side, the dollar side specifically, yeah, there is an issue. And you're right. And it's easier to assess the data because that's held through what's called the TIC data, Treasury International Capital. Okay, so they kind of keep track because they can of who's holding Treasury bonds, what are they doing with them, what are the new holdings, so that's harder to hide. Typically, central banks don't hold, they'll hold the majority of their portfolios really not out beyond 2 to 3 years. So they want to stay short duration by staying short maturity. So what's happening with them is, in one case, they've got bonds maturing that they're just simply not reinvesting the money. Okay, so there's that.
Yeah.
Then there are the outright liquidations and sales of the bonds. Now, how much of that is occurring? Well, the Chinese and Japanese Treasury holdings were the largest in the world. And so, yeah, the Chinese have been running down their holdings of Treasuries for a variety of reasons. Okay, so, and they haven't been repurchasing them.
Okay, yeah.
So if someone were to make the case that, well, okay, well, you know, maybe they just didn't like the yields, they sold at a profit, they're going to buy when yields have risen. Okay, well, they haven't done that. So are they waiting for, you know, the 2-year to go to a 5%?
Yes.
I don't know. But the trouble with this is that they're running up against a massive issuance need in the U.S. So the Treasury is going to have to issue a lot of debt. So there's already a $33 trillion accumulated, you know, federal debt.
Yes.
Right. And then you add to that, you've got annual deficits right around the $2 trillion level. So as these expand, you're going to have to issue more debt. You're going to have to borrow more money. But since 2020, you've seen, well, the 10-year yield has risen by a factor of 14. Okay, the 2-year note has risen by a factor of close to 20. So there is a significant, okay, so yields have risen enough to make the interest costs, now they matter.
Yeah.
I mean, they've always mattered, but politicians, I won't say who said this, debt doesn't matter,
yeah.
Deficits don't matter, at a 5% 2-year yield, which is, you know, I mean, Treasury issuance is concentrated around the belly of the curve, anywhere from 2 to 5 years.
Yeah.
And lesser issuance in 10s, and lesser issuance, you know, 10 and 30-year refundings. Okay, so now a 5% 2-year note matters, and it matters a lot, because you haven't seen a 5% 2-year note, you know, in 20 years. I mean, you haven't.
Yeah.
Okay, again, when debt was almost a third of what it is today.
Yes.
So it's tripled since 2000, and now we're at yields that are 20. So a lot has changed. So now your largest buyer, at least for the moment, is out of the market. So who's going to fund this?
Yes.
So you've got pension funds. Well, I think part of what it means is that you're going to have to depend more on onshore take-up, right? So state pension funds, insurance companies, so forth. Now, foreign central banks in the West, can they do something? Possibly. They don't really have the firepower of China.
Yeah.
I'd say right now maybe the wild card is Japan, but there have been developments in the Japanese economy and the Japanese bond market that make it would make more sense for the Bank of Japan to actually buy more of their own issuance, right, at higher yields, because now you've watched Japanese bond yields go from negative 27 basis points 3 years ago to plus 76 basis points, which is not a lot, but it's a movement of over 100 basis points, and bond math suggests that that is massive. Yeah. So Japanese bond portfolios, in many cases, have suffered more than U.S. Treasury portfolios. Yeah. So, you know, I mean, you know, Japanese capital sees more opportunity in Japanese equities and in Japanese bonds as opposed to U.S. Treasuries. So again, their buying base, their significant buying base isn't there like it was. The deficits that need to be funded are far higher, and the interest rates are much higher on a massive increase in the existing debt base. So there are a lot of monkey wrenches, you know, landing around the U.S. Treasuries.